Here's what's coming up on Strategic Wealth with Matt Dickett.
What are some solutions or some strategies? What's best for somebody to do?
It would see a 48% drop in value, or go from $441,000 down to $221,000. Now you can imagine the shock that this gentleman had when he said he was a conservative investor, but he's exposed to this much risk.
All right, let's talk a little bit about RMDs, or obviously required mandatory distribution. This is something that as you turn age 70 and a half, if you have any money in a qualified retirement plan, really whether you want to or not, you have to start taking these distributions out. So let's talk a little bit about some strategies as far as what to do with the money, because quite often our clients, sometimes they don't need it. And they're a little frustrated or aggravated that they have to take it. Obviously, that's out of our control. It's, the government makes us do it. But what are some solutions or some strategies? What's best for somebody to do with these RMDs when they take them out?
Yeah, what we use a lot of times is what's called a legacy optimizer. And basically what you do is you take your RMD, and obviously you have to pay your taxes on it, and then with that after-tax investment, you go open a strategy that will now grow your portfolio to a value immediately of what it could be potentially in 10 years. Then what it does is it'll grow tax-free until your death, at which time you would pass it on to heirs and beneficiaries.
Again, tax-free.
Tax-free.
Right. Yeah. So, Jordan, when you take a look at a strategy like that, obviously the whole reason of doing something like that is to try and maximize the amount of money that we're able to pass, or one is able to pass to their children or their grandchildren. When you meet with individuals, is this something that a lot of times they're aware of that they could do with their RMDs, or are they just typically spending the money?
A lot of times people are spending the money. A lot of times what we see too is that they know they have to take the RMD, but they don't know that there's any other options out there. So the big thing that we try to do is help educate them as much as possible, really show them that there are some different options out there. And then, like Dustin was saying, kind of give them some different potential solutions.
Now, obviously, one way that we can avoid having to take the RMDs is if we have the money in a Roth IRA, right? So if you have any money in a Roth IRA or Roth 401k, those do not require mandatory distributions at 70 and a half. And I get the question often from individuals, especially because they're frustrated. They don't want to have to take the money sometimes. They just want to leave as much to their kids and their grandkids. They'll ask the question, well, why do I have to take this? Why are they forcing me to take these withdrawals? And it doesn't matter where you have your IRA. It's not your financial institution that's causing this. It's the government. They are requiring it. And it's really because they're looking for the tax revenue.
Yeah, they want it up front or they want it at the back end. They're going to get their money, whether it's whether it's on a Roth or up front or an IRA.
So as you get older, obviously those individuals have arguably lived life right. If you're 70 and a half years old, your life expectancy could be another 10 or 15 years. Obviously, until you pass away, the money that's in the IRA accounts, that's not taxable until you try and pass it on to the next generation. So the RMD is just another way that the government forces us to take some income and obviously generate some income tax.
Right.
But the legacy optimizer, Dustin, if we can go back and talk to that a little bit more. So if someone doesn't need the money, right? You're forced to take it. You have to put that somewhere. Now, obviously, you could just put it in the bank or reinvest it somewhere else. But if you do those things, then that money is just going into a taxable environment, right?
Right.
So the money, while it's in the IRA, it's growing tax deferred. At some point, you have to start taking it. But then if you take that money and reinvest it in a taxable account, that's not really helping, right? So you could spend it. You could put it in a bank account or invest it in a taxable account. What are some of the other benefits of using this legacy optimizer?
Yeah, so with the legacy optimizer, like I said, so immediately what you're doing is you're increasing your estate value. So I had a client that had a $100,000 IRA, and the RMD at 70 and a half was just a little less than 4%.
Right.
So what we did is we just went ahead and we took out $5,000 out of that account, paid the taxes on it, and we opened the legacy optimizer. So now what that's done is that's actually increased his estate value from 100,000 taxable, so they would net somewhere around 65, something like that. And then what we did is we increased it.
So the heirs and beneficiaries, right? So
Yes,
you're saying
right.
100,000 in the IRA if the individual passes away after paying the tax bill.
Right.
If the beneficiaries chose to cash it in after paying the tax bill, they would get 65,000.
That's right.
Right.
Yeah.
Doing the legacy optimizer, how much is it then?
So it was worth about 130,000. So it immediately increases the estate value about 30%, but that's a tax-free 30%. So now instead of a $65,000 net, they're now netting 130.
You know, Jordan, I think a lot of times when individuals look at their money that's in their retirement nest eggs, I have a lot of clients that'll say to me that they kind of feel like they're needing to watch after that money for the next generation, right? A lot of parents and grandparents are concerned that, you know, the younger generations aren't going to have the same opportunities that they had. You know, we can make arguments all day long that the country economically is somewhat in a decline. Things like pension plans have gone away for the most part. You know, certainly a lot fewer companies using them today than have in the past. Social Security has its concerns, especially for younger generations. You know, there may be some sort of a means test or something of that nature. So I know a lot of parents and grandparents a lot of times are looking for ways to maximize the amount of money that they pass on to their children and grandchildren. When you take a look at individuals withdrawing their RMDs, other than the legacy optimizer, or other than spending the money, is there anything else that you might recommend to them?
Yeah, a couple of other potential things. You could do maybe a managed money account, because some people, maybe in a couple of years, they might need those RMD proceeds, but not in the immediate future. But you want to make sure that you have those funds liquid to where, even though maybe we're not spending it, we still have access to it. So a managed money type account could work in a situation like that. Possibly some annuities too.
Yeah.
Or
Anything
a
else you want to
Roth conversion. So you could take it out of the IRA, pay the taxes on it, and convert it over to a Roth account.
Yeah, so obviously several different strategies. Probably the only way to avoid having to take RMDs is to do what Dustin's talking about and do the Roth conversion prior to turning age 7.5 or possibly after that. But you know, once you're at that point in your life where you have to take these withdrawals, you don't want to not do it. The penalty is 50%.
Yep.
So pretty severe. Like Dustin mentioned, if you're around age 70, 71, 72, it's close to 4% is what the withdrawal has to be. Obviously, as you get older, the actuarial tables will require a larger withdrawal, but it never gets to a scenario where you have to withdraw like 30 or 40 or 50%. That's a misconception that's out there. But there are things that can be done. Jordan's mentioned the managed money account, or obviously the legacy optimizer is what's best for those that don't need the money and are looking to pass as much as they possibly can onto heirs and beneficiaries.
When you have confidence in your retirement future, you can live the life you've always imagined. Because of planning, you now have time to reflect on the wonderful memories of your life. You and your spouse finally have the luxury of leisure time together. To spend fun times with your grandkids, sharing the joy of their excitement about life. Smiling at the thought of quality time with your children and of picking up the check. At last, you have time to breathe and rekindle the love of your life. Why? Because you imagined what could be. You planned for retirement. So today, you own your future. Imagine what's next. Plan today, own tomorrow. Call Strategic Wealth Designers, 502-412-3354.
This week I want to talk about stress testing your portfolio and actually understanding and getting your arms around exactly how much risk is there in your portfolio. People come in all the time and they've been asked, how much risk are you comfortable with? And the standard answer is always, well, I'm conservative, or I'm moderate, or I'm aggressive, conservative to moderate. But what we want to do is we want to put a number on that, because conservative to one person may mean something completely different than it means to another. So what we always want to do is we want to assign a number. It's called our uncle point, because everybody's comfortable with a certain amount of risk, but if they get over that, well, they either want to exit the positions they were in or move it into something that's going to protect them from loss. So this particular client that we're going to talk a little bit about here in the example, his portfolio was worth $440,000. This gentleman came into the office and we ran what we call our risk assessment exercise. And what it does is it has several different options as to how much risk you're actually comfortable with. This gentleman chose portfolio A. And what that means is portfolio A says, yes, I'm willing to take a potential of 5% of a loss in order to gain 10%. Then it also puts a dollar amount on it. So, okay, I'd be willing to push $22,000 off the table in order to gain 44. Now, the next scenario, or portfolio B, is a little bit riskier. So it says, okay, 8.25% is about the maximum that I could stand to lose and not change my lifestyle in order to gain 16.5%. Portfolio C is a little bit more risk, and so on. So what we want to do is we want to understand, okay, how much are you, the client, actually comfortable with risk-wise? So again, this client here chose portfolio A. So then what we're going to do is from that point, we want to stress test his actual portfolio. Now, what stress testing means is we've got a software program that allows us to look over the last 100 years of the stock market's historical data and project pretty closely how your portfolio, or how each portfolio we're managing, would react based on different economic scenarios. So we've got so many scenarios that I could bore you with the information that we have. But what we've done is we've ran 3 of the most popular ones that people are asking about, or we may be hearing about in debates or on the news, things of that nature. So what we're going to do is just kind of scroll through each one of these. First of all, this is going to be a high-level view on the first page here. We'll go into a little bit more depth as we move along. So the first scenario we're looking at was, what if interest rates start to rise back to a historical normal level of about 5%? Well, this particular portfolio would react by dropping by 18.3% based on that scenario. The next one here is what if we hit that debt cliff? What if we hit that $27 trillion number that we're hearing about, and the U.S. defaults for the first time in history? Now, we all hope that this doesn't happen, but as an advisor, we need to be prepared that if something were to happen like that, that our clients are going to be okay, or as good as they can be. Now, this one here is showing if the U.S. defaults for the first time in history, it would cause a 47.6% decline in the total value of this portfolio. The last one here is what if we went through another scenario exactly like 2008? Now, if we went through another 2008, the positions that are in there right now would cause this portfolio to lose 48% in value. Now, this was very surprising to this particular client because he had said he was a conservative investor. Remember, he chose portfolio A, so he wasn't willing to take a whole lot of risk. But then when we find out what he's actually in, there's a complete mismatch. So what we want to do to show where we arrive at these numbers is we're going to look at the first one there, the rising interest rates driven by inflation. Now you're going to see the economic indicators there. We're showing the U.S. Treasury is projected to be at 4.75%, where it's up 2.88. You can see retail sales are going to fall by 1.44%. Unemployment would rise by 0.5%. And this particular scenario would go from $441,000 down to $360,000, which is a negative 18.3% decline. Below that, you can see how each position that's within the fund or within the portfolio would react based on that scenario. The next one we're looking at is the debt ceiling. So what if the U.S. were to default for the first time in history? Well, this scenario here has a completely different set of indicators. You can see the U.S. Treasury has now bumped the rate up to 6.31. You can see the consumer price index is up basically 0.25%. Gold falls by 28% in this scenario. Home prices fall by 16.41. And you can see this scenario would take the portfolio from $441,000 down to $231,000. Which is a 47.6% decline in the value. The last one we're going to look at here is what if we went through another 2008? If this particular portfolio and the positions that he holds within it were to go through another 2008, it would see a 48% drop in value, or go from $441,000 down to $221,000. Now you can imagine the shock that this gentleman had when he said he was a conservative investor, but he's exposed to this much risk. If you're not sure about your portfolio and the positions that you're in and how they would react based on different economic scenarios, make sure you call our office and/or visit our website for your portfolio stress testing.
Thanks again for tuning in to today's show. I have to tell you, Dustin and I have been receiving more calls than normal lately from folks like you because people are concerned with what's happening lately in the stock market. They've simply heard from their stockbrokers to stay the course, don't be concerned, but we're definitely seeing a reason to get a second opinion. Now, a lot of that, it comes down to having a plan.
Unfortunately, we've seen a majority of cases lately that people have done a great job saving for retirement, but they and their advisor don't really have a plan as to how to structure their portfolio in retirement.
Yeah, and this is especially the case when it comes down to structuring their portfolio for income. Studies today show that if you remain in the typical balanced portfolio, the appropriate withdrawal rate is 2.7%. So if you had $1 million, that's only $27,000 per year that you should be drawing in retirement. That just seems crazy.
Yeah. When we're structuring a portfolio during retirement, you're looking at closer to 5 or 6% withdrawals throughout retirement. That's why we encourage you to give us a call for a complete retirement review.
Yeah, we can take a look at your current portfolio structure and let you know what kind of yield you're accruing, let you know what kind of risk you're taking, and much more.
We'll spend some time talking to you about how to appropriately structure a portfolio during your retirement to generate an income where you don't have to lose sleep when the market isn't cooperating.
We also can't stress tax planning enough. A majority of people have saved for retirement, have their assets in retirement plans such as IRAs, 401ks, and etc. And guess what? During retirement, these are your most highly taxed assets. So we feel that it is our responsibility for our clients to find the best strategies to withdraw those funds at the lowest possible rate, or when the right opportunity rises, to shift those funds over to a tax-free asset. So again, we welcome you to give us a call for a free, no-obligation visit for your complete retirement review. We look forward to sitting down with you soon.
Strategic Wealth University, we're going to be talking about bull markets and bear markets, the difference between the two, how to spot them, and how a portfolio can be positioned during these different economic climates. So first off, what's a bull market? So a bull market is where a market is rising or is expected to rise. This in turn creates and promotes consumer buying, which continues to rise the price or the overall market index. Now, if we flip that on the other side, what's a bear market? So a bear market is where a market is falling or it's also expected to fall. Now, this in turn creates and promotes consumer selling, which continues to lower the price or the overall market index. Now, let's take a look at some past scenarios where bull markets have occurred. If we look back at 2000, we have the dot-com bubble. So after this followed a bear market. If we look back at 2007, 2008, we have the real estate bubble, and following we have a bear market. So if we look at 2014, 2015 area, we have a bull market caused by a variety of factors. Now, looking at the market climates, we can start to see a pattern emerge. We see a period of a bull market followed by a bear market. And what happens is yet to be determined for our current economic cycle, but if we look at past historical data, it's safe to say that another bear market is soon to follow. So something that we talk about is the likelihood of a market correction happening. Now, a correction on average happens every 7 to 8 years. In the 7th year, there's about an 80% chance that the market's going to go through a correction. And in the 8th year, that number jumps up to 90%. So we only have a 10% chance of generating a positive return in the 8th year. I don't know about you, but there seems to be so much more risk than there is really reward. Now, something that's very interesting is how these cycles, or bull and bear markets, travel, meaning how they move up or down. Now, a major misconception, especially for a bear market, is that it moves only down, meaning that the only direction over the term of the bear market is that only moves down. Now, what we see from past historical corrections or past bear markets is that there are and have always been wild upswings too. There could be a 15% downside correction followed by a 5% upside correction, followed again by a 10% downswing. Now, the most important thing to take away from this is that the 5% gain doesn't always indicate that the correction is over, and it is extremely difficult to time these brief or minor upswings. A lot of investors make the mistake of buying back into the market towards the peak of these minor upswings, and then as soon as the buyback or as soon as they buy back in, the price level or the investment continues to fall. In this instance, it is really important not to try and catch a falling knife. If you see that something's falling or it's probably heading that direction, it's best not to guess its floor or predict its bottom, because more times than not, based on statistics, we are not going to be able to consistently and accurately determine the floor of an investment. Now, bull markets are a bit more predictable, and while there are seemingly continuous upswings, there are some downticks as well. But the key thing to take away from bull markets and bear markets is the trend. I know we're about to have some graphics come up, so let me go ahead and explain these. In this first one, this is an upward moving bull market trend. Now, what do we see? We see an upswing, a small downswing, but the bottom point or the change of direction is never lower than the last uptick, meaning that each time there is an upward cycle, we're still higher than we were before. Now let's go ahead and flip the graph. I want to take a look at a bear market. So we can see from this that there are continuous down and up.
You're on the back nine heading for the clubhouse. Your dreams of spending time with family and enjoying retirement are just within reach. What happens if you end up in the rough? In these uncertain times, it's crucial to be prepared with sound advice. Strategic Wealth Designers is one of Kentucky's premier retirement planning specialists. For a complimentary consultation, call 1-502-653-6080. Strategic Wealth Designers. Plan to retire well.
This week in the office, we had an interesting case that we wanted to share with you guys. We had a couple, John and Sally, who had experienced some pretty large losses back in 2008, and moving into retirement, they just didn't want to go through that again. So Matt, can you help walk us through what we can do to try to achieve that?
Yeah, you know, a lot of times we'll meet with individuals where they've experienced big losses in the past, they're now going to retire, and they just say, well, how do you do this? You know, I can't go through another 30 or 40% drop like we've seen in the past. Right. But at the same time, I don't want to invest my money in savings accounts or CDs because they're just not paying anything. That won't generate any income. So how is it that we go about it? One of the things that we talk to individuals about all the time is that as you get closer and into retirement, one of the most important things you could do is make sure that you don't take losses, because what's going to happen is a loss is going to hurt you a lot more than a gain helps you as you move closer and into retirement. So, Dustin, if we look at it like this, you know, we get the question all the time where individuals will ask, you know, what is the stock market going to return as far as a percentage over the next 12 months? Yep. And obviously, neither one of us have a crystal ball, but we do know if we were to take a look at the, say, the 100-plus year history of the stock market, if we were to kind of, you know, plot on this line each year, we know that the majority of the time the stock market's going to be somewhere between a 25% gain to as much as a 25% loss. Now, obviously, we've seen it like 2008, where sometimes the market loses more, and then occasionally when times are great, sometimes it'll earn more than 25%, but the majority of the time, probably 90-95%, you can say during the next 12 months, we pretty much know the returns are going to be somewhere between these two numbers. For most, especially as they get closer into retirement, that's too large of a range.
Yeah, you can't do
right?
real planning with
You
that.
can't plan on that, right? Because this is going to hurt you really bad, and the chances of that happening aren't very good. So individuals say, well, that's just too wide of a range. Where we want to live with our clients, when we start talking about not losing money being the most important thing that you could do, but you still need to earn a reasonable return, what we want to do with our clients is we want to basically live right here. Somewhere between 0 and 15 is kind of where our threshold is. We want to draw the line in the sand and say, you know what, we're not going to lose any money, but we still need to earn a good, reasonable rate of return, maybe up to, in the really good years, maybe we could earn as much as 15%. But one of the things that's important about this, whereas we talk a lot of times, we're not a perfect fit as a firm to help everybody, what you have to understand is in order to provide this safety, what we're really doing is we're giving up any potential for that. So when the market does great, we're just not going to participate. And when we eliminate the potential for that, what we can pretty much do is eliminate the potential for that.
Right.
Okay, or even if we had losses, maybe they would be very, very small losses. So the majority of our clients want to basically live somewhere in between these numbers. What that ends up equaling over time is maybe an average return of somewhere between 6 and 8%. So individuals, as they move closer into retirement, they can't ride this big roller coaster. You know, you don't want to have big losses followed by large gains. What you want to do is draw a line in the sand. If you never take on losses, you don't have to take a whole lot of risk shooting for very high returns because you're never digging your way out of a hole. And it sounds pretty simple. Obviously, it gets a little more complex than that. But that's kind of the mindset that individuals have to start focusing on as they move closer and into retirement.
Thanks, man. And that was this week's Scenario of the Week. If you have more questions about how you can accomplish this, please feel free to call our office and or visit our website.
Remember when life was simpler? When things didn't move quite so fast, and the world didn't seem so complex? Remember that? We do. And as the world around us has continued to speed up, becoming more complicated, and still a bit uncertain, we have managed to keep things simple, providing sound, easy-to-understand financial advice and customized roadmaps for the road ahead, from tax reduction strategies, investment advice, and guaranteed retirement income you cannot outlive, backed by the claims-paying ability of insurance companies. We can be your single point of contact, a single call, a voice you recognize well, and a partner who can be by your side for the entire journey. We can't stop the world around us, but we can help ensure you're prepared for what's to come. To schedule a no-obligation meeting, simply contact us today